All right. Today is Monday, the 1st of July. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. We are starting fresh. New half of the year. Whatever happened in the first half, that's the past. You won money, you lost money, you dropped in your head and you couldn't get up. Your significant other cheated on you with 4 different people at the same time and they filmed it. They sent it to your mom. All of that is in the past now. We don't care anymore. We got a new, fresh start right here, folks. And speaking of, by the way, we will have a change in the formatting of the programming for both the public and the membership channels. And they're good changes, by the way. Everybody gets more. You get more videos, not less. Well, we're going to do some Stagflation. Instead of having one long video, we'll split them into 2, and we'll give you 2 videos during the weekend instead of 1. We're also going to do changes in the members' videos. All good changes. Everybody talks about shrinkflation in this economy, but here we have splitflation, which means we give you more and more. But we'll talk about this over the weekend, folks. For now, what's really interesting about this economic story, which includes the macroeconomics and the market dynamics. What's really interesting is every day we get more and more pieces of the puzzle of how all of this, what we've been seeing since 2009, the rescue operations and the post-pandemic rescues, how all of this will shape up at the end. And it's not a good picture, folks. I don't think this is a surprise to anybody been watching this channel. We've been talking about stagflation. We've been talking about the icy hot phenomenon in the economy. We've been talking about how the Fed will fail in keeping inflation low and how they're going to have to capitulate and cut rates to rescue something in the economy at the expense of letting inflation go again. And of course, that's going to mark the nail in the coffin to this whole thing. We're not talking about, the pandemic or 23. We're talking about the whole thing. What happened in 2008, 2009, that shock should have stayed with us for a long time. But of course, they initiated the rescue. But this one will be the big one. There is no rescue when the big one hits. And in the last 2 weeks, we got really important pieces of data, aka pieces of the puzzle. And the picture is becoming clearer and clearer every single day. Without further ado, folks, we begin with the wall of worry. And again, we have the policy risk. We have the election risk, which is about to flare up now. We have the geopolitical risk. We have China risk. We have the Fed's risk. And we have the risk from the Bank of Japan. I mean, you saw what happened today. The yen continues to collapse. And this story is going to be front and center really soon because it will have a dramatic impact with the U.S. markets, specifically the bond market, the currency markets, and the economy. The Bank of Japan spent billions of dollars in an attempt to prop up the yen, and they failed. And I promised them in this channel, they will fail until they begin raising rates higher. And the data that we got, at least last week, core CPI in Japan moved higher. So it merits the Bank of Japan to raise rates higher. Of course, the problem is if they raise rates higher, with all of the debt they've been accumulating for years, it's going to be a disaster for the Japanese economy. But it will rescue the yen. Rescuing the yen means that the Japanese stock market, the insane run that we've seen as of late, will come to an end and we will see a crash. But this is not what's been preventing the Bank of Japan from increasing rates and rescuing the yen, because at some point, rescuing the currency becomes more important than keeping the bubble alive. The real reason behind what's been keeping the Bank of Japan from rescuing the yen is the U.S. Treasury led by Janet Yellen. And the reason behind that, if the Bank of Japan indeed increases rates, what do you think that's going to do to bond rates here, interest rates here in the United States? Well, demand for U.S. bonds will go down in the longer end of the yield curve, which means that rates here in the U.S. will go higher because now Japanese bonds are paying you interest rates all of a sudden. So demand will migrate from U.S. bonds to Japanese bonds, which means rates will go higher here. If that is the case, it goes against the entire manipulation scheme by Janet Yellen that we covered in detail in this channel that began last October when Janet Yellen decided to manipulate the supply of treasuries by increasing the supply in the shorter end, not the longer end. And of course, it doesn't make sense. We covered Senator Kennedy. Why would you borrow at a higher interest rate in the shorter end of the yield curve when you can borrow at a lower rate for 10 years, for 30 years at the longer end of the yield curve? And we know what it's all about. It's market manipulation to prevent a banking collapse before the elections. That's what it's really about. So now when we talk about the yen collapsing, at some point the Bank of Japan will say, okay, Mrs. Yellen, we know that you don't want us to do it right now, but at the end of the day, we're the Bank of Japan. We care about Japan, the Japanese economy. We have to rescue our currency at the end of the day. So with all due respect, you can go F yourself, and we're gonna rescue the yen by increasing rates. And if that happens, rates will go higher, and they're beginning to go higher. Did you take notice of the action in the bond market today? What was the reason behind the big pop in the 10 all the way to the 30-year bond yields? It ain't the data is coming out absolutely ugly. It's the fears coming out of Japan. And if these yields continue to go higher and we have a risk of 5% again in the 10-year, what do you think will happen to equities? What do you think will happen in the banking sector that we have here with all of these held to maturity losses, massive losses like we've never seen before? More on that in a minute, but we begin with the political risk. Because since the debate, it's been the story. And I said before, look, it doesn't matter. Whether it's Biden, whether it's Trump, it doesn't matter. The market likes both. Both of them will serve the stock market, not the public. We know that. But the risk comes from the uncertainty. And after the abysmal debate that we got from the Democratic side, from Joe Biden's side, last Thursday, the speculation right now is he's going to be replaced. And this is something that we've never seen before, that we have an incumbent president who's removed from the re-election bid because they no longer have their marbles together. That's the kind of uncertainty that could shake the market. And of course, the replacement of Joey B depends on the polls. We have a really good one for you in the show tonight. But if you missed it, yesterday we got a phone call from former Presidents Barack Obama and Bill Clinton. That was fun, and they gave us their opinions about what happened in the debate and what's going to happen to Joey B. So check that out if you did not. I mean, where else you can find a YouTube financial channel that gets you two former presidents in one interview? Not even NBC or CNN, CNBC can get into that. Anyhow, post-debate, of course, even Politico said that Biden is toast. I don't need to show you the clips or what happened. You know exactly what happened. It was a disaster. It was embarrassing. The moment he began walking to the stage, I said, oh, no. This is going to be a disaster. The man is walking like a robot. And he's pointing, hey, Jack. He looks like a corpse, a mummy, walking into the stage. And of course, the performance was a disaster. And when we look at the betting average post-debate, the chances of Joe Biden becoming president absolutely collapsed, and the chances of Donald Trump becoming president skyrocketed. But the stock market didn't react that much. It was flattish on Friday, flattish today, and everybody said you gotta wait for the polls to come out, the post-debate polls, because those are gonna lead us and guide us. And here we have one from Harvard-Harris. Really interesting poll, and we begin, of course, with the debate, what folks thought about it. And here it is, 2 in 5 voters said they were more likely to vote for Trump after the debate, with less than 1 in 4 said the same for Biden. But the most interesting number from all of this is if you look at the more or less likely to vote for Biden, look at the independent or other affiliation. Less likely to vote for them. 45% of independents say less likely to vote for Biden after the debate. So the finding here is not that Trump was great in debating. It was absolutely awful. He lied. He made up a lot of stuff. He couldn't answer questions. He kept dodging and talking about other stuff, giving one-word answer, two-word answer, and then dodging to another topic. But it was the fact that Joe Biden was absolutely horrific. Again, based on the debate, seemed more presidential. We see that Donald Trump beats with 48%, better communicator. Of course, Trump 55, Biden 24, has better policy ideas. Trump wins, understand the American people better, was more engaging, more electable. All of these questions, Trump wins over Biden. So needless to say, it is a disaster. We talk about the fitness for the presidency. You got the most important finding here, I would say, I have doubts about his fitness, or is he mentally fit? When it comes to independents, 79% say have doubts about his fitness versus 21% who say he's mentally fit. When you look at independents, did the debate show Joe Biden that he's too old or he's fit to be president? 81% said showing that he's too old. So this is a major problem, folks. And in the past, we said this in this program a long time ago, that when it comes to the elections, we're probably going to see Joey B being taken out and replaced by you-know-who. They're going to say, oh, Joey B decided to spend more time with the family in Delaware. And now you know that for everybody to see, it is a disaster. And there's no other way but for him to be replaced at this point. And that's going to cause a little bit of volatility because if it's not the vice president, who's it going to be? What are their policies going to look like, et cetera, et cetera. So there's more for the market now to consider than before. But the most important thing is, what do voters care about? And surprise, surprise, it's the economy again. And let's see what happened here post-debate to the question whether the U.S. economy is on the right or wrong tracks. 63% say on the wrong track. Only 29% say on the right track. So again, when you hear on CNBC and the propaganda media that the economy is the bestest ever, and the stock market the bullest ever, not showing up here in real life. How strong do you think the U.S. economy is today? 64% now say weak, only 36% say strong. In answering the question, would you say that your personal financial situation is improving or getting worse? That's really important. 52% say it's getting worse. Only 23% say improving. That number is dropping, by the way. And voters say, when asked, do you think your personal economics right now are excellent, good, fair, or poor? 27% say poor, 34% say fair. So all in all, 62% say fair or poor. Now go back a month ago, folks, just a month ago in the May poll, 55% say fair or poor. So the number jumped by 7 percentage points to 62% in a matter of a month. That's huge. Gee, what's been happening in the last month or so? We talked about it, the deterioration of the American consumer, and the data showed that clearly. We have more data for you in a minute, but here it is again. Which of these issues is the most important to you personally? Inflation, number one by far, 45%, up 4 percentage points from the poll from last month. So again, the CPLI, the propagandists in the media can say that inflation is cooling, but in real life, folks continue to say that inflation is not getting better. Inflation is getting worse. And it's not because that inflation is moving higher by a lot, but because their spending power is now being eroded. So their ability to withstand inflation is getting weaker and weaker and weaker. The gap between the spending power and the current level of inflation is widening. Inflation can stay static as it is, sticky. But if your spending power is dwindling, the gap is getting bigger, and it gives you the perception that inflation is getting worse. Here's the last one. Have price rises and inflation proven to be sticky and here to stay, or have we made progress getting them in line and under control? Because Mr. Powell says that soft landing is coming, inflation is coming down to 2%. He doesn't see the Stag or the Flation. Let's see what the voters think. 70% say proven sticky and here to stay. Only 30% say have made progress getting them in line and under control. It's really important if you look at the subgroups. Look at Hispanics, for example. So when they talk about Trump gaining more traction in Hispanics and black voters, look at Hispanics. 64% say that inflation's sticky and here to stay. 64%, same percentage point, among African Americans say that proven sticky and here to stay. And that's a major, major problem. At the end of the day, it's the economy stupid, and it's really inflation stupid this time around. And they're not getting a good grip on it. Not the administration, not the Federal Reserve for sure. And you saw what happened today with energy prices moving higher. And that leads us, if the voters care about inflation the most and they think that their livelihood is not improving, they think the economy is weak and inflation is not improving, so we have to go back to the wall of worry and discuss the Fed's policy. What's going to happen here in this kind of risk? In the wall of worry. Last week, we put in a show. Do you see it now, Mr. Powell? The Stag and the Flation. Well, we gave you two examples from this economy. The collapse that we see right now in the housing market. You saw what happened to housing and construction stocks last week. Huge drops. When you look at pending home sales, new home sales, disastrous numbers, way below expectations. Expectations were positive, 2% in pending home sales. In reality, it was minus 11% plus. And now folks talk about, okay, housing prices might come down because activities are slowing down dramatically in the housing sector. But at the same time, you look at container shipping rates. Those are moving higher. Oil prices are moving higher. So when we look at the container shipping rates, what's going on with the Red Sea situation, the increase in insurance rates, in transportation rates, and the fact that companies now might choose air cargo in lieu of sea shipping because it's going to take longer for sea shipping to arrive and the risk and all of that. So they have to pay more for air freight. Where do you think they're going to pass that extra cost that they have to pay for transporting goods via air over sea? They're going to pass it down to you, baby, the consumer. The problem is we got companies like General Mills, for example, saying we can't pass the extra increase in cost to the consumer anymore because the consumer is getting annihilated. And company after company after company, any company that has any attachment to the consumer in the economy, look at their stocks. They're doing absolutely abysmal. But folks, this Red Sea situation is getting worse. Maybe you caught up the report from 60 Minutes over the weekend. We're now shooting missiles to take these Houthi drones and rockets. And these missiles that we're firing cost about $4 million a piece. And in 60 Minutes, they say that we shot hundreds of them. So that's a lot of money being just blown up in air. And now, I mean, after how many months and Operation Prosperity, whatever the hell it is, no progress. The Red Sea remains a no-sail zone, no transportation zone, nothing can get in and have guaranteed safety of passage. And the aircraft carriers are going away. Mission failed. And here's the latest headline. U.S. struggles to deter Houthi threat as crisis spirals. Keyword spirals. Not getting better, getting worse. Today alone, 2 ships got hit, and you see these attacks via sophisticated drones and anti-ship ballistic missiles, really sophisticated type of attacks happening on a daily basis now. This is going to stay with us. It's going to increase the cost of commerce. And of course, the geopolitical tensions keeping oil prices high. You guys saw the rally that we got in crude today, and Matt Weller says crude oil prices are perking up today, to say the least. The key resistance level to watch is 84. If we get above there, the 24 highs at 87 come into play. I say more than 87. Of course, we always have the recession scares when oil goes down, but right now, in the last 2 weeks, we got really ugly pieces of macro data indicating that the economy is actually crumbling. But oil went higher either way. Do you see the Stag and the Flation now, Mr. Powell? And the fact that oil went higher because of the geopolitical risk indicates the severity of this problem. You can get recessionary data, but oil will keep going higher so long as we have the geopolitical risk. Look at the monthly chart of light crude oil futures. We begin with the major turnaround points. If you look at the MACD indicators, the shifts from bearish to bullish, not the smaller ones in the monthly chart, but the bigger ones, the more obvious ones. Let's mark them here in the chart. You can see we have 1, 2, 3, 4, and 5 right now appears to happen. We'll look at the previous 4, beginning all the way back since 2007. If we mark them, we see a rally in oil in 2007 to the top of oil bad a little over 120%. In case number 2, we see a rally in crude worth a little over 65%. And then in case number 3, we see a rally of more than 120%. In case number 4, we see a major rally worth more than 250%. And now the question becomes, it looks, if you believe in the charts, it looks as we have another explosion in the price of oil. Will it be an amicable 60% rise? Would it be 100%, 200% rise? If you're looking at this chart, how can you have any sense of security for sitting at the Federal Reserve right now? Would you really cut rates? Because the moment you cut rates, this chart is going to explode higher. We'll be at the 125, 130, maybe 140. Maybe we'll take the highs from 2008. That's deflation, Mr. Powell. At the same time, where's the Stag? Last week, we got abysmal housing data. Pending home sales, new home sales plunging. And you see the problem here, folks, that we have the income needed to buy a home right now is way above the average income. So housing affordability is absolutely abysmal, meaning we will see again, definitely, without a doubt, we will see another housing crash. You know, in the first one, folks said, oh, housing never crashed. We've seen ups and downs in the economy, Great Depression and the likes. But housing is the one sector that never crashed, and it did crash. Because speculation, bubbles, manias, that's what causes a crash. And right now, we're in the biggest one of all time. Today, we got another piece of data solidifying the weakness that we see in housing and construction. Construction spending posts bigger than expected drop in May. And this data came out today. Then you look at the consumer side. Look at the retail side, for example. If we have a booming economy and a bull market and all of that, then shouldn't retail businesses thrive in this economy? Look at Walgreens. The stock crashed by 24% in a single day last Thursday, the worst crash since the 1970s. We said this before, folks. If you watch the live streams in this channel, we talked about this in the beginning of the year. The Walgreens is going to go bankrupt. There's no use for pharmacies anymore. You go to the store, everything is locked up. The prices are insane. The stores, it looks like you took a trip in a time machine back to the 80s. And this is not the good 80s. There's no dope, there's no good music, there's no big hair, nothing. Just get the shitty lighting fixtures. And this is just among many other reasons why we'll see Walgreens going bankrupt. Among them, of course, the kiss of death by Jim Cramer, who said Walgreens tonight will be amazing. And of course, bankruptcy is the next step for the company. But joking aside, you could dismiss this and say, but Walgreens, that's a troubled business, Maverick. Come on. It doesn't say anything about the economy. It doesn't say anything about the consumer. It's not just Walgreens, folks. Look at the stock of Nike last week, wiping out almost $30 billion in a single day, down over 20%. We're talking about Nike here, a blue chip, a staple. Why did the stock go down 20% in a single day? Consumer demand is weakening. It ain't just Walgreens. It ain't just Nike. It ain't just the housing market. It ain't just General Mills. It ain't just Lulu. It ain't just all of the stores that we got earnings from, and they went down big. You got H&M, another store, middle class, regular consumers. The stock plunging big last week. Why? The outlook is not good. Consumers are running out of cash, folks. Do you really think that the economy or the stock market, even the B2B businesses that we have right now leading the stock market higher, such as Microsoft, such as Meta, Google, all of these companies, NVIDIA, of course, leading the market higher. When do you think this feedback is going to reach them, that the consumer is collapsing? And we got to stop spending, the B2B spending that is keeping the economy and the market going right now. Just a matter of time. We talked about Gen Z in the previous video, and here's the headline for you. Borrowers, especially the young, struggle with credit card debt, potentially bad sign for the economy. So you got the seniors and the retirement class. With the bubble in the stock market, they feel fine. Cruises are doing better than ever before. It's a boomer economy. But then you look at the heart and the core of spending in the economy. We're not just talking about healthcare, medications, and cruises. The rest of the economy depends on the young. And the young are getting broke. Years of inflation, years of higher rates, what do you think is going to happen? When we look at excess savings since the pandemic, poof, gone. We're now negative. No more excess savings to keep the insanity of spending on credit cards on steroids, as we've seen in the last couple of years. Those days are gone. And all of that spending on credit cards, by the way, folks are now surprised that they can't pay the debt anymore. It's not a video game. When you have a bunch of numbers on the screen that you got some credit and you can just swipe the credit card and nothing happens. You got to pay that at some point. And the longer it takes you to pay that, the higher interest rate and fees you're going to incur. Well, guess what's going on right now? You look at the 90 days plus delinquencies. In the first quarter of this year, you can see a massive surge in credit card delinquencies. We're having the same trend as just before the crash in 2008-2009. Auto loans also moving higher now, reaching almost the highs that we've seen during the recession in 2009-2010. Bottom line is, if you don't have another stimulus, if you don't have another wage bump out of the blue, what do you think will happen here? Savings will continue to dwindle. Debt will continue to increase. More folks will fall further behind. They're going to begin to change their spending habits. We're already seeing that in the economy. And this feedback is going to reach the bigger companies, and they will stop spending. And once they do that, the whole thing is gone. And when the whole thing is gone, and now everybody's left with over a decade now of debt accumulation, how do you suppose we will pay all of that debt? Corporate level, municipality level, consumer level, especially, of course, if the Fed cuts rates to rescue the economy, and then we see a surge in inflation because oil would go higher. And then they have to raise rates again while the economy is crashing. How do you think we're going to pay all of this? There's no way. Who's going to be at the other end of that stick? If you said the banks, you're right. And the Fed came out last week and said, oh, we did the stress test and the banks, beautiful. Nothing will happen. We can crash the economy and the banks will be just fine. Then comes JP Morgan and says, yeah, right. The Fed is actually giving us a rosier picture than our own estimate. And this is more evidence of the incompetency of the Federal Reserve. So all of you who trust Jerome Powell and you trust the Fed that they're going to give us a soft landing, Powell and the Fed have absolutely no clue what they're doing right now. And that should be terrifying to everybody listening and watching right now. But, of course, in the meantime, what about the market, Maverick? All-time highs. Come on, the economy is great right now. Okay, let's play that game. Why is the market doing fine and trading at all-time highs? When we look at the S&P performance lead over the equal weight index. So if we look at the actual S&P versus the equal weight that we talked about, the RSP, the biggest outperformance gap in history, bigger than the peak of the dot-com mania. It's a sign that we have a bubble, and it is the most dangerous bubble of all time because the bubble is now the big one. We talk about the big one. This is the big one. It is in the biggest stocks in the world, $3 trillion plus. When these guys come down, remember when we talked about too big to fail back in 2008? And by too big to fail, we were talking about a minuscule $800 billion. Oh my God, if we have a blow up of $800 billion, the economy is going to collapse. Here we're talking about trillions, baby. Trillions. And why is that happening? The bubble that we see in NVIDIA, it's irrational, doesn't make sense at all. They're selling chips for 70 grand a piece because we have this AI mania going on right now. But what do you think will happen after that? AI mania will subside. We'll have oversupply versus less demand as the economy weakens. And the weakness in the consumer reaches companies like Microsoft, like Apple, like Amazon, the customers of NVIDIA, whose valuation surpassed all of these customers. It doesn't make sense at all. But nobody asks questions right now. Here's the good news for you, though. If you're freaking out that, oh my God, this is going to blow up tomorrow, hold your horses, calm down. The fact that it is the biggest one of all time, it means that it's going to be a tougher nut to crack. And the reason is a lot of these companies have a lot of cash. Their books are a lot more solid than other bubbles before. That doesn't mean that this bubble is sustainable or it's not a bubble. It actually means it's more dangerous, but it's going to take more time and more erosion of the economy for these names to come down. You look at Nvidia, for example, when you're charging 70 grand a pop for a chip, now you have a lot of cash in the books. What are you going to do with all of this cash? Either you do M&A, and they try to do some of that, buying mediocre companies, but there's a lot of risk in that. So the other solution would be, once the stock of Nvidia drops down 10-20%, you'll see a floor from the buybacks. So they're going to blow up about $20-50 billion in buybacks. That's the only choice they got. It'll rescue the stock a little bit, move it higher again. But again, at the end of the day, when the bubble pops, Nvidia will realize that they blew up $50 billion in nothing, and the stock will be lower than the price that they bought for. And that's going to be disastrous for the company. But that's further down the line. For now, place your chips, keep gambling, especially if you have any insider trading, any filth that's going on, the cheating that goes on every day in the market because the SEC in the coma, the Fed doesn't really care, nobody cares. The dynamics in the market right now is fraud. One word, fraud. Look at what's going on with the Roaring Kitty, for example. He did the pump and dump scheme in GameStop, now he's doing another one in Chewy. Oh, he tweeted a picture of a dog. We gotta go crazy now and buy the stock. It rallies by 20%, then closes negative by 5%. Everybody gets back, and the guy, of course, cashes in, as he did in GameStop, exercising the call options. Now he bags the dumb sheep followers. Nobody asks questions. How did he get $245 million? Where did that money come from? We talk about fraud in the market. That's the dynamic. We talked about Revvion, the pop that we got last week. Well, guess what? Well-timed Revvion options traded ahead of the VW investment announcement, which popped the stock higher. So somebody knew, bet on it, made millions of dollars, and then the stock goes down, pump and dump. You know the deal. Perhaps more alarming, the piece of news that we got from Australia today. We have a coal mine blaze, a big one, that will have a huge impact on the coal production globally. Now you might think that, hey Maverick, but come on, a coal blaze, that's an act of God. No, it's not an act of God. You want to hear crazy? You want to go crazy with the conspiracy theories? I'll go crazy on you. I mean, remember what happened before 9/11 when somebody shorted the airline stocks? Then they came out with the investigation and said, yeah, nothing to see here. It's okay. Remember what I spotted for you last week in the unusual activities for BTU, a coal miner? Let's go back and listen to what I said. Then we have BTU. This is for coal, and I'm showing you the 3 minutes chart because we've seen a pump by the end of the day. I think there is more where that came from. I think there are folks who are covering their shorts and buying calls for some reason. I don't know what it is, but I think it could be a catalyst for BTU to be really interesting tomorrow. And here's the update. The stock rockets by almost 10% since then. Somebody knew that there was going to be a blaze. Sounds crazy, but how do you explain the unusual activities in buying millions of dollars of call options ahead of time and the stock popping with huge volume just before the close on Thursday? How do you explain that? So once again, it's the insanity of the mania bubble in the AI and Nvidia going higher every day, and the $250 billion pump that we see every day in the market. If it's not for Nvidia, let's pump Amazon 3% or Apple and Microsoft 3%, and we keep the index afloat. Market manipulation using fake money, and of course fraud. In all of this insider activities that we see every single day. We have more for you when we segue to the coverage of the stock market, which we're going to do right now, folks. Let's begin with the closing of the indices, and here we go. The diamonds in the green by 50.66 points, or a gain of 0.13%. The Nasdaq in the green by 146.70 points, or a gain of 0.83%. And the Spider also positive by 14.61 points, or a gain of 0.27%. A shortened holiday week. We got the 4th of July, so the gravity is to the upside. This is a no-brainer, but warning sign, we got the Russell 2000 small caps down 1.70 points, or a loss of 0.84%. And the reason is yields moved significantly higher today. Watch the Bank of Japan. Something is about to happen with the yen. We'll look at the sectors. The leader of the market, of course, tech. What's new here? We have the $250 billion pump, the daily one that we see, now went for Apple, Microsoft, Amazon instead of Nvidia. So we see technology at number one. Then we have marginal gains for cyclicals, for energy, for financials, but then the rest of the market is deep in the red, led by industrials, real estate, and metals. We look at the breadth, not pretty good, even though the indices are positive, but look at this. 27% advancing in the NYSE versus 71% declining. In the Nasdaq, a little better, but still bad. 34% advancing versus 63% declining. Once again, 52-week lows. We have a new 137 new 52-week lows versus only 39 new 52-week highs. Awful. The dynamics of the market right now, absent of the 44% contribution of the year-to-date gains to the S&P 500 by one name, NVIDIA. Absent of that, the market would be crashing right now. And look at this. This is the heat map. Majority of stocks lukewarm to red, but we have some bigger names like Apple 3%, Microsoft over 2%, Amazon over 2%. You add it all together, that's over $150 billion in market cap added one day in these three names alone. Well, that's going to make up for NVIDIA being flattish. And the net effect, of course, is the indices going higher, but then you peel the onion, you look around and you see ugliness across the board. And folks, bear in mind that Friday's and today's actions could be a little deceiving. And the reason is Friday was the end of the quarter, the end of the first half of the year. So we have what managers do is booking profits from the runners, like NVIDIA, for example, and then dumping the losers. So you see stocks that were down in the quarter getting hit even more on Friday's session, but comes today, and the managers begin to buy for the new quarter and the next half of the year. Look, for example, what happened to MRK Merck. Down over 4% last Friday, and then we see a rebound of about 3% today. Somebody sold. It was a big winner for the quarter, for the year. Somebody sold Friday. Somebody picked it up today. So we have shuffling by the managers. And I think next week, because this week will be a shortened holiday week, but next week we'll get more clarity on the theme in the market than what we're seeing right now. Then when we look at the heat map for the ETFs, it gives you a clearer picture of the disaster that we see. Pretty much everything is down. The exception, you got the XLK technology. And even chips not performing today. SMH flattish, SOXX flattish. The XLY consumer cyclicals, positive because of Amazon, but the rest of the components are absolutely disastrous. And the TLT was down about 2% today, meaning that yields exploded higher. Why would that happen if we have recessionary data? Look at what's going on with the EWJ, Japan, and the yen. That explains it. And of course, the casualties. Small caps, mid caps, any yield-sensitive ETF, real estate, construction, the XHP, ITB, getting hammered the most. Moving on to commodities, here it is again, JPY, Japanese yen, down about half a percentage point. It was actually uglier earlier in the session, but you see the weird dynamic of the dollar going higher, but commodities also going higher because the dollar is going up just because of the weakness in other currencies. So we see crude oil up over 2% today, both the WTI and Brent. The gasoline RBOB opening a gap now, up 3%. So today's dynamic favors the refiners over big oil. Then you have heating oil, aka diesel, up over 3.25%. But natural gas, of course, when we see flows into crude, that comes out of nat gas, which has been the performer for a while now. But today down over 4.5%. When we look at softs, cocoa down about 5.25%. But again, you can't discount that cocoa is going to top here and move down again, because every time it goes down, it comes back up again. OJ up a little over 2.5%, the rest flattish. We see marginal gains for lumber, marginal losses for sugar and coffee futures. You look at metals. Once again, the only one I do is gold for now, but you look at the rest, okay, silver, copper positive today, but not by a lot, and the sustainability is under question. Platinum down over 2.25%. Palladium holding a little better. Keep an eye on palladium. Maybe we're bottoming here. But I would still not buy it. I'd stick with gold when it comes to metals. Now, when it comes to grains, this is the new session, but let's look at some charts because we got some developments today. We have some big moves to the upside in grains. If we look at the chart of wheat, for example, daily chart, what can we see here? Look at the MACD indicator. Are we about to see a change from bearish to bullish momentum? Yes, that's the assumption. What else can we see? The RSI doing the same. And then we have a important resistance level here at around 594, 593. If we pass above that, then we have a confirmation that we got a bottom. What comes after that? How about the shoulder line of the topping head and shoulder formation that we got? That becomes the next resistance, but one step at a time, we see improvement in wheat right now. If we trade above the shoulder line, then it's a confirmation that wheat is now bullish, and we will see a challenge of the highs again. That will be inflationary, of course. Then you look at soybean oil futures. Big pop today, over 4%. What can we see in this chart? No clarity in the momentum indicators in the MACD, for example. If we look at the candlestick pattern, can we identify a double bottom, for example? Yes, we can. Then we can identify a resistance at the top of the formation in or around 46.32. We close above, we're bullish, and we're probably going to challenge the highs at 50. Then we look at corn futures. This is a falling knife for now. The supply is higher. China's producing more. Many other countries producing more. But is it so oversold right now that it's worth at least taking a shot on for a rebound? Maybe. We have support for now in or around 400. You can take a shot and buy some corn futures contracts. Betting on a rebound, you might get lucky here. But you got to have a stop loss. I would place it at 400 or 399. If we trade below these levels, then we have lower lows to come, and it is a falling knife. Moving on to the big casino, the options market, what do we see here? The volume is about to get lower. I mean, it's low today, kind of. Relatively, you have Nvidia still hot with over 4 million contracts today. Tesla's hot with about 3 million contracts today. Of course, mostly calls versus puts by a lot. Across the board, 60s, 70s. So it's a one-way street in terms of betting, which gives you the false sense of security. And this is why we see the VIX getting absolutely hammered. Nobody wants to buy puts at this point. Could be a sign of complacency. But again, the volume will go lower as we head closer to the 4th of July holiday. And that keeps the gravity to the upside. Let's look at the bullish versus bearish flow for the buy side. Bullish, we see Amazon, Tesla, GitLab, SMCI, AVGO, Gold, GLD. In the bearish flow, we see the indices, the SPY, the SPX, the Qs. So they go bullish Amazon, Tesla, Apple, but then they hedge by shorting the indices. That's what's going on in the buy side. We look at the bullish versus bearish flow for the sell side. If you're selling puts in the money, specifically, you have bullish flow. If you're selling calls in the money, out of the money, it is considered bearish flow. And in this case, we see bullish flows for Nike. Maybe the sell-off, at least for now, is over. Folks are closing their puts, at least some of them. We see names like Moderna, CMG, Chipotle, TLT, Starbucks, Lulu. In the bearish flow, we see Amazon, Tesla, Meta, Apple. So you got to combine this piece of information together. Today, we have bullish buy flow for Amazon, for example. Somebody bidding for more gains to come. The same token, somebody's booking their gains, and that's considered bearish flow. So now you have to look at the amounts and the expiration dates. The higher the amount, if it is on the sell side, then that side is dominant. The risk becomes to the downside. If the buy side is more dominant, in the case of Amazon, with higher flows, larger amounts, then the risk becomes to the upside and just somebody booking their profits. That's all there is. Let's look at the unusual activities that we got, and we have Moderna. We have a lot of sells of the 105 puts. The expiration date, Jan 25. So somebody's booking profits here. It means that the pressure to the downside is coming to an end. And if we see folks buying out of the money calls on Moderna right now, we could see a rebound. And folks, you got to remember, sometimes I give you ideas in the morning brief. Today you got mad at me because we don't have a morning brief in a boring day, holiday week. Nothing burger, misleading kind of day. But you can look back at the morning briefs we've done before. Some of the ideas in the charts don't play out right away, but once they hit their targets that I identify for you, they become back in play. And the greatest example of this is Moderna. We look back at the morning brief that we've done in June 3rd. We talked about a lot of names, but we talked about Moderna too. And the idea was, if we look at the chart, once you crack below the 20 days moving average, you got to trade puts on Moderna. Didn't happen that day. It didn't happen for a few days after that. But then once it happened, look at the chart, the update right here. Once it happens, Moderna flushed down all the way to the target that we identified at 115.5. So now the fact that we have closing of these puts, the 105, it means that some of that downside pressure is getting out of the way. And it might be a good idea to play a rebound in Moderna. Then we have bullish activities for GitLab. GTLB buying the 75 calls for 26. Spending millions and millions of dollars here. What do we see in GitLab? Of course, this is a longer term bet for 26, but it's still significant. At least it gives you the comfort that somebody thinks that GitLab will stay with us all the way to at least 26. If we look at the daily chart, maybe a cup and handle pattern, and we have resistance at the gap at around 53.11. We crack above, we got more gains to come. We'll be at 55.60 in no time. So take a look at GitLab. Maybe it is an idea to follow here in the bullish flow. We also have HUPS hubs. Somebody spent a lot of money here buying the 600 calls for the expiration date August 16th. Something is going on with this chart. Look at it again. Maybe you'll see an opportunity in hubs. It's expensive. It's a over $500 stock. So look at it if you like it. Follow some of these calls ideas. Maybe it's an insider play after all. Then we have a long bet for Tesla. Tesla was up today big. And somebody now is betting that we will see 220 at least, if not 240. They bought the 220 and they bought the 240 calls for the expiration date of July 19th, spending almost $3 million for those. We have the sales number coming out soon. I think the stock is overbought and we might see sell the news, but here the trader disagrees and they think we'll see more gains to come. More short covering, more gamma squeezing. Then in the bearish flow, we have the IWM ratio back spread. This is a complicated strategy, but it is a telltale that somebody thinks the IWM is going down. And this somebody is a professional. The main trade is selling the 202 calls for the expiration date of August 16th. The quantity is about 3,000 contracts. Then they buy the insurance policy. The 225 calls, same expiration date, but double the quantity. The idea, of course, that the IWM by August will be way below 202, and they can receive the full credit of about $1.5 million from the trade. But in case it goes against them, the 225 calls will appreciate in value minimize the decay or the loss in the 202 calls so the trader can manage the trade at that time if they need to get out of it or add to it or average down to it or sell more. They can manage it at that point, having the insurance policy of 225 calls in case the IWM goes higher, not lower. But for now, it gives me conviction that here's a trader, a sophisticated trader, that thinks the IWM will be heading down. Then we have the ticker ANSS. This is for ANSYS. Somebody bought the 310 puts for different expiration dates beginning from July 19th and then Jan 25. All the way to Jan 26. So they think that this stock will be way below 310. And they spent about $29 million on this trade alone. So it's a big one. Somebody has a high degree of confidence that this stock is going to crash. Then we'll look at the bearish flow. How about the VIX? It's a call options trade, bullish for the VIX, but bearish for the market. Somebody bought the 15 calls, expiration date July 17th, betting the volatility will go higher, spending about a little over $400,000. So again, we see these bets once in a while, but somebody believes that the stock market will be down and volatility is about to increase. Let's do some charts and then wrap it up. Charts where we have some updates, of course. We'll look at the SPY, flattish for the day, but any update here? I think that we're keeping the support of 544.12 in or around that number. We got one hourly candle in today's activities closing below by a cent. I don't count that. I need to see a clean, decisive close below. Then we can say, okay, we topped here. We have no energy to move higher. And down we go. You look at the daily chart. For now, if you look at the MACD indicator, we're shifting from bullish momentum to bearish momentum. But we're doing so via consolidation, which is usually a bullish formation. It says once we cool off these overbought conditions and we shift back to bullish, we will see the energy being released. So for now, the chart is consolidating and asking for sellers. Any sellers here? Anybody wants to book profits in the SPY? I'm ready to go down. I'm ready for a correction. If nobody wants to sell, then okay, the buyers are going to show up. The overbought conditions will cool off. Somebody will find this okay enough to get in, and we will see the energy being released to the upside. When it comes to the Qs, hourly chart, what do we see here? We have some resistance at around 487. We stopped there in or around that number about 3 times now in the hourly chart. Maybe 4th time is a charm and we break to the upside. I'm not going to feel comfortable that we're going down until we break at least 473 from an hourly time frame. Then you look at the daily chart in the Qs, a little weaker than the SPY. Here we have a shift from bullish to bearish, and we see a little bit of a correction going on. So it's a little weaker. We can argue that it is a bear flag. We need to see further evidence by breaking at least 473, and then we can talk about, okay, the Qs is about to weaken, and we're about to initiate a correction. We look at the IWM small caps hourly chart. What do we see here? Today, it looks as a bear flag pattern. Whether that's going to play out or not, that's up for grabs. I would have been more confident to say it's going to play out had we closed below 201 today, but who knows, it might happen tomorrow. All in all, you look at the formation in the daily chart, the MACD is shifting to bullish, but we see weakness every time it pops higher. It fails right away because of the pop in interest rates and bond yields. So we see right off the gate in the daily chart, we lost the 20 days moving average and the 50 in blue. Number 1. Number 2, if we draw a resistance line with lower highs, if we stop here, we've failed before even getting to the resistance line. That's a bad sign. And then we see, of course, that the topping head and shoulder formation, the shoulder line, was never challenged, was never traded above. So we have weakness in the IWM. You put it all together. On the weekly chart, what do we see here? Topping head and shoulder. The weakness is evident here. We need to see yields going down dramatically for this guy to recover. Otherwise, down she goes. The dollar, for now, looks positive, but stalling. Maybe losing a little bit of momentum. Look at the MACD indicator, kind of getting exhausted here from the recent rebound. And if that is the case, and we see the dollar softening in the 4th of July holiday, we're heading to it. And that's going to be good for the old man gold. I mean, look at what's going on here. We got the bear engulfing candles. We got bear flags that play out for the day. And then we see a bid to buy gold right away. I trust the MACD indicator. I see the possibility of a shift from bearish to bullish. If that is the case, I think that the energy will be released to the upside in gold. And I'm not worried a lot about the dollar going higher here because I've seen the dollar and gold going higher together as of late. With that being said, I'm a GLD guy, the commodity, not the miners, the GDX. The GDX is below the 50 and the 20 days moving averages, 20 in white, 50 in blue. Of course, it's going to go higher if we see the commodities price going higher. But I think that with the rise of oil pricing, as an investor, you got to consider the input cost for these miners. You're better off sticking with the commodity or the physical gold than the miners. The SLV looks a little better here. We're above the 50 days moving average in blue. If you look at the MACD indicator, maybe we're about to give a confirmation for a shift finally from bearish to bullish. Clean up the chart a little more. We have a resistance line of lower highs, and maybe now we've formed a double bottom. We are ready to cross above it. And I said, folks, I'll buy SLV at 26. That's my price. We got it. Now let's rock it higher and get a breakout in SLV. GLD, SLV doesn't matter. I think both of them looking pretty good by now. If we look at UK oil Brent, what do we see here? Bull flag playing out above the 50, above the 20. Matter of fact, the 20 in white is about to cross above the 50. That's a bullish confirmation. We solidified 85 as support. Testing. And now we see the breakout. What is the next stop? I mean, you read the commentary from the experts. They say around 87. I say the upper Bollinger Bands around 88. But again, it's not overbought. So if we want to stretch it all the way to 89, 61, or a big rally all the way to the highs in one shot, I think that's a possibility. Of course, the XLE oil stocks are lagging today, but I think we will see positive reactions if we see the continuation of the rally in Brent and WTI. Then we'll look at the 10-year yield daily chart. What do we see here? A breakout, moving higher now. We talked about the bear flag. The chart is asking any sellers, I'm playing out bearish momentum here, folks, but I'm going to run out of time. If the sellers don't show up in any chart, when you see a bear flag pattern and the MACD is shifting from bullish to bearish, the chart is asking for sellers. If sellers don't show up in time, the buyers are gonna, and the momentum will shift from bearish to bullish. This is exactly what we see in this chart in the 10-year yield. Now, there is a risk of 4.5, and if we pass 4.5 this time around, I think we'll be back at 4.7, and after that at 5%. This is not good for the home builders, of course. The XHP, we talked about the daily chart before. If you see rebounds, opportunities to short because we have an inverse ABC playing out in the weekly chart. Indeed it did. And now we're at the lower boundaries of the Bollinger Bands in the weekly. I think we have more losses to come in the XHP as we see the housing mania coming to an end. Yet the IYR real estate is not responding negatively, continues to consolidate here, so we have no update, we'll move on. The ITB construction is the one I'm shorting right now, but we do have the 50 days moving average worth of support at around, let's say 96. I think if we hit that, let's say tomorrow or anytime this week, I'll book profits from this trade, and I'll short individual names instead in home builders and construction. Then we'll look at the KRE regional banks. I said it's the only one in the yield-sensitive cohort that I would go long in, and indeed, it's the only one that broke out, despite the fact that yields went higher. But is it way too high right now outside of the upper Bollinger boundaries, maybe forming a topping candle? I think if you went long the KRE today or tomorrow would be a day where you want to book profits, hold on the sidelines for a little bit, and then see what happens. If it's worthy of coming back in, we'll talk about it at the time. If not, then we'll find another chart to play. The VIX Volatility Index hourly chart, what do we see here? Above 1324, VIX bullish, below it is bearish. So we know it is bearish, and they tried to give it a shot today, couldn't happen. And we see a big flush down, although the market didn't find a lot of benefit from this flush down in the VIX. Now we're at support, oversold at 12.18. Can we see a rebound in the VIX tomorrow heading into the 4th of July holiday? If we see that, it'll be because of a piece of a macro data or a commentary from Powell tomorrow. If that is the case, VIX goes higher, SPY goes down. That will go counter to the consensus and the assumption that in the 4th of July holiday weekend or trading week, we have shortened trading, lower volume. That makes the gravity to the upside. But you always have the exception. Although you look at the bigger guys like Apple, the big kahuna, that looks okay, and we're above 214.24, the number that I identified as a target to close above to go with the 220 calls. Because right now we have a confirmation that we're playing an ABC pattern. So here's a giant that's looking okay, and it could push its way higher and keep the indices alive, even though the VIX might make a comeback. At least an oversold rebound. Then we look at the Souffle Tesla hourly chart. What do we see here? We got the breakout of the tension pattern that we talked about last week. Above 180, you're bullish. Below 168-ish, you're bearish. So we're bullish all the way above 180, and we have a breakout out of the pattern. But I said that we get to 200, 199, we want to book profits because it's going to be really, really overbought. Got to pull back Friday. But today we see a continuation of the demand for the gamma squeeze for out-of-the-money call options. We see a pop higher. Again, 2 cents. I would say it's overbought. We see sell the news, but I was wrong at the 200 target, so what do I know? We might see a continuation of the gamma squeeze. It's always good not to be greedy, though. If you bought the 190, 200 calls or the 195, 205 calls, you gotta book some profits at least. Or up, aka roll, your strikes all the way higher to the 210, 220, but only with half or a portion of your profits, not all of them, in case the trade goes the other way. Then we have another big kahuna, perhaps the biggest one, NVIDIA. What do we do with this guy? Hourly chart, consolidating, doing nothing at all. We can look at it from a bearish lens and say we have a topping in the shoulder, down we go, 117 is the neckline. We lose that, you gotta short NVIDIA with both hands. We can look at it as a bear flag consolidation pattern. We can use the bullish lens and look at it from the perspective of a higher low. and the energy from the consolidation will be released to the upside. How do we know which one is which? Zoom out to the daily chart. We still have a bear flag pattern here. If we close above the 20 days moving average, I would say that the upside risk is more dominant. If we stay below, I would say that the downside risk is more dominant. For now, we're below the 20 days moving average, a closing of 124.30, while the 20 days moving average at 124.57. Interesting week for NVIDIA. We'll see what happens, but I will use the 20 days moving average as my guideline. Bitcoin, tulips, what do we see here? If we look from the bullish lens, we can see that we have a sign of life showing up here. Possibility of shifting the momentum from bearish to bullish, as you can see in the MACD. We're facing the resistance of the top of the breakdown candle, maybe forming a bull flag pattern, and then the energy is released to the upside. But then we use the bearish lens, and we can still argue if we fail here, if we stall and fail, that we can still see an inverse ABC pattern leading us all the way down to 56,500. So right now, I would say if we trade above the 20 days moving average, I would say the bullish outlook wins and we'll be at about 67,000 as the next step. We stall here, and we take 60,000 as support, and I think that the odds would say next stop would be 56,500. Let's move on to the conclusion of this video. What do we have on the economic calendar this week? Beginning tomorrow, July 2nd, we have Fed Chairman Powell, this time around from Portugal. He's touring like the Rolling Stones, courtesy of the taxpayer, of course. Private jets, hotel rooms, meals, hookers. And the question is the guy doing the job, or did he give us the worst home affordability in the history of this country? Why should we pay him for all of these trips? The guy's a multimillionaire. But he could move the market with the commentary tomorrow that we have job openings and auto sales. And of course, folks, since we did not do a public video over the weekend, you get it today, Monday. Of course, every time we do that, we give the members a bonus video for the week. So be on the lookout for that. And again, I'll be back in Discord tomorrow. We'll do a morning brief, I promise you. And we'll take it from there. If the market gets slow and nothing is going on, then we'll take it easy. We're probably not going to have a show Wednesday, and then of course Thursday, the holiday, nothing's going to happen. So it's going to be a shorter week here either way. If you don't hear from me again, folks, happy 4th of July. But for some of you who are going to hear from me, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
The system's insolvent. No one knows what to do next, except repeat the insanity till the next bubble blows. That'll be the one, the big one. The tipping point, just like the tulip.